Welcome. Today we are going to discuss about how duplication in your portfolio can impact the returns. More often than not, we are comfortable with having a few funds in the same category to ensure that you get the best out of all the funds. But in the process, sometimes it may lead to duplication of stocks that these funds hold, right? So that leads to essentially duplication in your portfolio. But what's wrong if, because when you look at the portfolios of equity funds, you will see some of the common stocks everywhere, like Infosys, TCS, or HUL. What's wrong? It's okay to have common stocks, but when they account for a chunk of each of the funds that you hold, what happens is that when these stocks underperform, your entire portfolio or the funds that have a high overlap with such stocks all go down together. So that means essentially that you are not having varied strategies or varied approach to investing. So they either go down together or they go up together, and therefore you lose out on certain other set of stocks that may have done better in a period of downturn, etc. So this is one primary reason in equity you need to have variety in strategy and ensure that the portfolios don't have too much of overlap. In debt, it's a very different story. You don't need to worry too much about overlap in debt. For one, the universe of instruments out there is pretty much the same for most of the fund houses, and what you're looking for in debt is more stability and some decent coupon or appreciation, or the duration strategy that funds use. So it's not so much about holding the same government instrument in A fund and B fund. So you can set aside the fact that there can be duplication in debt. In fact, sometimes it might help to hold two or three debt funds in the same category from different fund houses, because if a fund house has a liquidity issue, having the other one might provide some safety for your portfolio. So let's focus on duplication in equity. How do you identify this duplication and what sort of corrective action you can take? So we have to help you do this, we have what is called as a mutual fund overlap tool. The link is given below. You can go and check it. So in this page here, I have given three funds here. You can give any two funds and look at the overlap. Or if you are a prime investor already, you can give up to three funds and look at the overlap. Now I took three funds from the same house, say fund house, to show how fund house pretty much spread the same set of stocks across funds. I've taken flexi cap from HDFC, top 100, and capital builder. You will see in all three put together, this region, this Venn diagram gives you the region of overlap in all three, which is a whopping 46%, right? Now let's break this down and get into individual funds. Where is this high overlap coming from? You will see between flexi cap, which was earlier the erstwhile HDFC equity, and top 100, you have a huge 72% overlap, right? That is really high. So basically, and when we talk of overlap, this is the weight, this is the proportion in terms of value. This is not just the number of stocks, because you can have high number of stocks but the weight may be very different. But when there is a significant weight overlap, it has a bearing on the returns directly. So the 72% is quite high. Flexi cap versus capital builder at 50 and top 100 versus cap 53 is also somewhat high but acceptable. What is acceptable? In general, we have seen 50, maximum of 60% overlap between any two funds is common, especially when they are in the large cap or large cap oriented, like flexi cap and focused or value contra. They do have that kind of overlap. In mid and small cap, it is less so. So up to 60% of overlap is kind of acceptable, but anything beyond that, like the 72 that we are talking of, is very high. So essentially it tells you don't need to own both these funds. It is enough that you own just one of them, right? So that's the primary use of so you are reducing. You could possibly go for any other fund where you will have less overlap. I'll just give you here another example. I'm going to take, just two funds to provide this so that it's easier for you to kind of understand. So look at this. I have taken HDFC Flexi Cap and Parag Parikh Flexi Cap from the same category. Now look at the overlap. It's just 25%, right? So just 1/4 of the portfolio was overlapping. This is because Parag Parikh flexi cap has a small portion in international stocks, and it also focuses on some mid and small cap stocks that HDFC may not. So here, if you had held HDFC and Parag Parikh, there is really no concern here. And you will see that the number of stocks here that are overlapping are just a handful. Maybe, something like 7 stocks or 8 stocks maximum, going up to 10 stocks are overlapping. And the good thing is also, even if there is an overlap, this tool here also goes further down to tell you their performance metrics, so that if you decide to keep one and not the other, how would you go about doing it? So we have here the Sharp, which is the risk adjusted return. You can see that it's much higher in Parag Parikh in this case. Then you have outperformance over benchmark, outperformance over the category, and what is the proportion of loss instances. So in what proportion of times has the fund really gone down? I mean, given negative returns. So these information further help you make a decision. And even if you find that difficult, if you're a prime investor, we directly give you our view here. You can also go to our MF review tool to check our view. In this case, one fund is a clear sell and the other is a buy. Of course, the overlap is minimal here, so it doesn't matter. But in the earlier one that I said, where you have 3 funds, if you had to decide between them, what would you go for? For example, I'm adding a third fund here. Right? I'm adding a very large fund that, with a large AUM. And, the overlap seems quite minimal here. But if you break them down individually, you can see that the overlap is high between HDFC flexi cap and Kotak flexi cap at 42%. And Parag Parikh, has very little overlap with the other funds. So you're on safe grounds there. But let's look at the performance here. You will see that the Parag Parikh fund has a much higher, Sharp ratio, followed by Kotak and by HDFC. And in terms of deviation and in terms of outperformance, of course, over category average, HDFC seems to have done well in recent times. But most of the metrics, Parag Parikh is very high and Kotak is kind of coming next, while HDFC is much lower. So if you had to remove the overlap between HDFC and Kotak, you can also look at our call here. We have given, a sell call here and a buy call and a hold call. Please note that this video is not to give any recommendations. I'm just sharing, how our portfolio, your portfolio duplication can be identified, and how our tool goes one step further in terms of also giving you recommendations, not for the overlap, but on the funds. If you find high overlap and you have to choose one over the other, this performance metric along with our call will help you decide. Do take a look at it and give us your feedback. Thank you.